Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
All right, let's get into it. We have three big stories for you today. First, we're diving into the US economy's identity crisis. JP Morgan's CFO sees strength, but many economists see a recession on the horizon, and a key indicator, the producer price index, is flashing a serious warning. Then we'll look at a wild proposal for the US government to buy a stake in Intel after a tense meeting between its CEO and Donald Trump, a move some analysts are calling a multi-billion-dollar bonfire. And finally, we'll unpack a bizarre deal where the US wants a 15% cut to let Nvidia and AMD sell chips to China, only for Beijing to tell its own companies, like Tencent and Alibaba, to reject the offer. Let's start with a single contradiction that defines the US economy right now. One of the nation's top economists just declared we're, quote, on the precipice of a recession. But just days later, the CFO of America's biggest bank, JP Morgan Chase, told investors, quote, we continue to struggle to see signs of weakness. The consumer basically seems to be fine. So is it a catastrophe in the making or a resilient powerhouse? The signals are pointing in completely opposite directions. Interestingly enough, this confusion is so profound that experts are now turning to artificial intelligence to try and make sense of it all. AI models are sifting through not just traditional reports, but also alternative data, credit card transactions, satellite images of shipping ports, even social media sentiment, hoping to spot patterns that human analysts are currently missing. The situation presents a fascinating duality. On one side, the alarm bells are deafening. Economists are warning of a return to 1970s-style stagflation, with job creation in May and June described as almost non-existent. The integrity of that very job data is now being questioned, following the dismissal of the head of the Bureau of Labour Statistics. This has sparked serious concerns about political interference, and that uncertainty alone is enough to spook the markets. And yet, consumer spending, the main engine of the economy, is holding up stronger than anyone expected. It seems our spending habits may have fundamentally changed. You know, modern tools like buy now, pay later services are making it easy to make purchases without the immediate financial hit. And research shows people using them spend significantly more. This plus automated subscriptions creates a kind of spending inertia that can mask underlying economic anxiety. Our wallets are on autopilot, even if our brains are worried. But that's not the whole picture. The real turning point is inflation. While consumer prices are up 2.7%, the bigger clue lies in wholesale prices, what producers charge before goods even hit the shelves. That number, the producer price index, just accelerated at its fastest pace in over 3 years. A huge driver of this jump is the delayed impact of tariffs. For months, companies sold cheaper pre-tariff inventory. Now, that's gone, and the higher costs are finally hitting their books. It's a clear signal that corporations may soon pass those costs directly to you. It all leads to the ultimate question: are we just in a temporary slowdown, or is the ghost of stagflation, that crippling mix of stagnant growth and spiraling prices, truly making a comeback? The threat looks different today. Back in the 70s, it was an oil shock. The modern equivalent could be a digital shock. Imagine a sudden collapse in the semiconductor supply chain or a massive cyber attack. That is the new face of stagflation we have to watch for. Speaking of the fragility of our semiconductor supply chain, the government might be about to make a huge controversial move to shore it up. The most unexpected news in the finance world today has to be the report that the US is considering buying a stake in the struggling chip giant Intel, which sent its shares soaring. Now, this isn't just a simple bailout. It's a major shift toward what's called techno-nationalism, where national security and economic policy become completely intertwined. The goal is to build up critical domestic industries like semiconductors to reduce reliance on foreign countries. But the risk is that it can distort the free market and even spark a trade war. The report follows a deeply contentious meeting between Intel's CEO Lip-Bu Tan and Donald Trump, who had publicly demanded the CEO's resignation over alleged ties to Chinese firms. Now, a potential government deal is on the table to revive Intel's loss-making business and speed up its delayed Ohio factory. One analyst called it a game changer, but here's where it gets interesting. This decision brings both potential benefits and comes with inherent risks, especially for Intel's leadership. A CEO has a legal duty to shareholders to maximize profit, but with the government as a major shareholder, the CEO is suddenly serving a political mandate, like building a factory for national security, even if it's not immediately profitable. It begs the question, who is the CEO ultimately accountable to? However, if you zoom out, you'll see another layer to this. An analyst from Hargreaves Lansdowne warns that government support doesn't fix the underlying competitiveness gap. And that gap is a chasm. Intel lost its manufacturing edge years ago to Taiwan's TSMC and has almost no presence in the booming AI chip market dominated by Nvidia. It's even losing market share in its core PC and data center business to rival AMD. Propping up Intel with taxpayer money could have serious unintended consequences, creating an uneven playing field. After all, AMD and Nvidia have been innovating and winning in the free market. If the government swoops in to make Intel a national champion, it could stifle the very competition that drives the industry forward. Worse, with reports that its latest manufacturing process has yield rates below 10%, it raises a familiar question. Is Intel becoming the semiconductor industry's version of a too-big-to-fail bank? This all leads to the single most explosive question captured by a brutal assessment from Bernstein analysts. They warn that without a rock-solid turnaround plan, a government investment would be, quote, economically equivalent to simply setting tens of billions of dollars on fire. So while Washington debates whether to pour billions into one American chip giant, it's simultaneously trying to profit from two others in a deal that's causing its own firestorm. A seemingly impossible collaboration became a reality yesterday. The US government brokered a deal to take a 15% commission from Nvidia and AMD in exchange for letting them sell advanced AI chips to China. This isn't your typical tariff. The US is effectively monetizing its national security policy, taking a direct financial cut from the sale of sensitive tech to a rival. Critics argue this sets a dangerous precedent where security could be seen as something negotiable for cash. This has ignited a political battle. 6 Senate Democrats released an open letter blasting the decision as a reckless plan and a cause for serious alarm, arguing that chips like Nvidia's H20 and AMD's MI308 could directly strengthen China's military. The administration fired back, with the White House spokesperson calling the concerns quite rich and dismissing the senators as irrelevant experts. The core technical fear is that even though these chips have reduced performance, it might be possible to circumvent the limits by clustering thousands of them together with clever software, achieving capabilities that rival the more powerful, restricted models. Now, get this. Nvidia's position is that staying engaged in the Chinese market is vital. They're afraid that if China is completely cut off, it will be forced to develop its own separate AI ecosystem, splitting the world into two competing tech bubbles and threatening US dominance long term. This is where the situation takes a more complex turn. After all that political infighting, it appears China may not even want the chips. Reports are now surfacing that Beijing is urging its own tech companies to avoid buying US technology, with one analyst calling it a hard mandate. This signals a genuine pivot to China's own domestic industry, where firms like Huawei are making huge strides. In fact, their Ascend 910C chip already achieves around 60% of the performance of Nvidia's top-tier chips for some tasks. Regulators in China have reportedly ordered major firms like ByteDance, Alibaba, and Tencent to suspend all Nvidia chip purchases pending a national security review. So, believe it or not, Washington is locked in a battle over a deal to sell critical technology to its main global competitor, a competitor that is now apparently refusing to buy it. What exactly is the end game here?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.